Hello. Unlike any other country in the world, the government budget assumes a lot more significance in India. This is not only a statement of government's income and expenditure and some tax provisions, but also it outlines the whole economic and even political agenda of the government. If we read the budget speech right, we believe that the agenda of this government is to create more jobs by harnessing the demographic dividend of India. The agenda is to do ease of doing business, which can promote entrepreneurship. The agenda is to simplify the whole tax structure and several other government regulation to promote the entrepreneurship and make the dream of Make in India true. The agenda is to revive the rural economy with a focus on the farm sector, where millions of people can be pulled out of the abject poverty, and also by doubling their income, you give a big boost to the consumption. The agenda is to create a solid macroeconomic foundation, and therefore a fiscal consolidation has been given a due emphasis. There were a lot of argument in favor of doing a little more spending and deferring the target on the fiscal deficit that may have led to instant gratification by getting slightly higher growth driven by the consumption, but it would have impacted the long-term macroeconomic stability of our country. We believe that the focus on fiscal consolidation with the incremental reforms to improve the supply side, to create more jobs, to ensure that India remains solidly on the path of a good macroeconomic stability, I think that this is going to be a good budget from the market's perspective. The number of pages devoted for simplification of the tax structure and resolution of the disputes, earlier disputes, leads me to believe that government genuinely wants to work towards ease of doing business, improve the ranks of India for the global investors. This will also promote entrepreneurship. Prima facie, looking at the budget numbers, the numbers look quite credible. We think that government has shown a strong resolve to remain on the path of fiscal consolidation, which will also pave the way for some more monetary accommodation. We will not be surprised if RBI does an intermeeting rate cut before its scheduled April policy. Along with some of the other growth related measures that have been taken in the budget, and some more monetary accommodation can revive the overall growth. On the consumption side, the measures that have been taken in this budget to boost farm income, to boost rural incomes, whether it's the more spending on irrigation, on rural roads, on rural electricity, crop insurance, and several other social security measures, will go a long way in reviving the rural economy where a large part of India lives. There are already signs that urban consumption has been doing well. Along with the impact of 7th Pay Commission and the one rank, one pension and all these government measures, we think that overall consumption is likely to get revived. While the private capex will still take a long time to get revived, we think that government's resolve on the infrastructure spend, particularly on sectors like railways and roads, will revive the overall investment cycle. And after some time, when private sector has more confidence in terms of the consumption related growth, as well as the government's infrastructure spending, helped by the global FDI that we have been receiving, all these should lead to private capex, but at a later stage. In the interim, we believe that the measures that have been taken in the budget and also the overall cyclical recovery should also lead to a recovery in the corporate earnings, which has been under pressure for last several quarters. We believe that the overall earnings recovery is likely to get more broad-based, unlike what we have seen in last 5 years. There are measures taken to improve the state of the financial sector, which has been struggling with the problems of the NPAs, whether they talk about changes in the Surface I Act, whether the strengthening of the asset reconstruction company framework, whether the new bankruptcy code, along with several other measures to revive the financial sector. The budget should be taken positively by consumption, agriculture, financial, infrastructure related sectors. While some of the measures can be termed negative for certain businesses or certain sectors like upstream oil companies or maybe some auto companies which have been hit by the luxury tax on cars. But overall, if the budget is likely to boost consumption, including the rural consumption which has been under stress, or the infrastructure spending, or the ease of doing business, or opening of FDI and simplification of tax laws and administration, all this augur well from a long-term macro perspective. The focus on fiscal consolidation with a strong resolve and a commitment to stay on the path of fiscal consolidation over a longer term will put a solid foundation for India's longer term macroeconomic stability. With the new monetary policy framework that has been institutionalized, we believe that structurally India could be on a path of a nice era, non-inflationary continued expansion of growth, which some of the other countries in the world have seen for a long time, and that should pave the way for a structural bull market. Markets have been under stress not only for domestic reasons but also some of the global reasons. We believe that this budget will give the right growth impetus to the market, will also give a lot more confidence to the global investors investing both in India's equity and the bond market, as well as businesses who are putting up FDI in India. The overall revival in growth should help in improving the corporate profitability, and given where the valuations are after the recent market correction, we believe equity investors can expect very decent returns over the next couple of years. As far as the bond market is concerned, the market had a lot of fears regarding the expected government borrowing for the next year, but with the government sticking to the fiscal deficit target and the gross and net borrowing numbers for the next year are a positive news for the bond market. We expect an interest rate cut in the next policy or before the next policy, and that will also help the bond market. Of course, the rally will get capped because of the higher borrowing by the state governments and the expected supply of the Uday related bonds. A big event is behind us, and our overall assessment is the union budget has positive implications for both the equity and the bond market. Markets have been volatile, but our advice to investors would be to take advantage of this volatility rather than getting swayed by it. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.